All right, welcome to another edition of Frequently Asked Questions. My name is Jesse Rivera. I'm a mortgage broker and licensed in the beautiful state of California.
And I'm Sean. I am licensed in most of the states here in the continental U.S. As a loan officer for hometown lenders. Damn
All
it, I didn't
over
want
the
to say
place.
that.
He's licensed all over the place. Uh, so what'd you do, Sean? It was a holiday weekend. Did you do anything fun?
No, actually, it's just so nice and calm here. We actually just kind of stayed home. My wife and I we just hung out here
Yeah,
by the beach.
yeah.
So watch the boats go by all day. What about you guys?
Oh yeah, I did a barbecue, did a hike, went on a bike ride, and I worked a little bit
Oh,
too. It was beautiful. It was hot on Saturday. It was a hot day. It was a hot day, but yesterday was very nice.
yeah.
So it was a nice weekend. So what are we going to talk about today?
Today we're just going to talk a little bit about kind of the definition of what kind of mortgages you and I do and the
Mm.
different kind of programs and some of the things that are involved with primary versus secondary home versus an investment home. So
Okay.
first thing I want to discuss though will be the kind of the main theme that you're going to see for almost every mortgage broker, loan officer, even most of your banks. Most of the mortgages, 99% of all the mortgages that happen are underwritten to Fannie Mae and Freddie Mac guidelines, so they're resellable on the secondary market. That means, the bank will chunk up mortgages and resell them by blocks of 1,000, and banks do that because it allows them to move their money
Mm.
around, and
Right.
smaller companies, especially mortgage brokerages,
Yep.
if they're running their own lightning lines or whatever, they all of these loans are all underwritten to the same exacting guidelines. So
Right. Right.
that's kind of the general theme. There's some smaller stuff, where they'll keep something on portfolio, where the large some of the mid-sized banks will have what's called portfolio products. They'll have very specific niche markets that they'll cover very specific types of loans, and they'll keep them on their portfolio.
Hmm.
But most of what we're talking about here is going to be just all the stuff that's resellable on the
So
secondary
so why
market.
do they sell the loans? What's the purpose of that? I mean, why don't they just keep the loans?
So, well, that's a great question. I mean, so banks are regulated pretty heavily on how much they can lend out, and like for those who don't know, since we got rid of the gold standard, now they it was initially they could lend basically 10 times of whatever actual cash they had in their coffers or whatever they had in their bank account, their business bank account, and now they've even upped the ante with some of the lightning lines of credit that come from some of the wholesalers all over the country. So really, they're lending on even 100 times. So for
Mm.
every dollar they have in the account, they can lend a
Yeah.
100 times that. So they kind of repackage loans together, and they'll identify some of the like what they want to keep on the books, and then they'll kind of move some of those off so that they have more money available to keep loaning out.
Oh, so
And
they get their money back and they could relend and do it over and over again.
exactly, they
Yeah.
can just keep that process going. And then some, banks try to typically they'll pick kind of what their bread and butter is. Wells Fargo, particularly, they're really all about the jumbos. And so they pretty much keep all their jumbos on hand, and then they'll resell off most of their other stuff. But the rest of the banks, they all kind of pick
Yeah.
which ones they like to keep in house. Most of your loan officers, your brokers out there, they'll even try to talk about, oh, we use these guys because they keep 99% of their loans in
Mm.
house, and your loan won't be resold for servicing. And I
Hmm.
would be a little leery when someone
Yeah.
starts trying to tell you that. That's
Right.
a sales pitch. Most of your loans are going to be resold.
Yeah. And to add on to that, I mean, when you get a loan, your loan officer is going to tell you, well, we need this amount of income for you, or we have to look at your debt to income, we have to look at what kind of property it is, we have to look at a whole bunch of different things, and there are all these guidelines and rules we have to follow, and that's where this comes from, right? They
Right.
have to follow these
Exactly.
guidelines in order to
Uh-huh.
sell the loan
Right, because
because,
otherwise they're stuck holding on to the loan,
yeah,
and then they can't
right,
loan out. They can't leverage out at 10 times or 100 times
yeah.
that dollar amount for that loan that they're stuck holding on their portfolio. Exactly.
Exactly. So I
So,
mean, when we let you know that we need this, it's not us. It's not even the lender. The lender's
yeah,
going by the guidelines they have to go by so they can sell the loan. So everybody
right.
has to follow them pretty much, or they have to keep the loan, like you
Right. Yeah,
said.
exactly. Yeah,
Right.
exactly. We're all underwriting to either Fannie Mae or Freddie Mac
Right.
or FHA, the 4,000.1.
Yep.
Everybody's underwriting to the same guidelines. It doesn't
Right.
matter which loan officer, which mortgage broker, which bank you go to.
Yep.
It's all going to be the same unless they have some little niche product, and
Right.
usually those products are only brought up as there's some government policy in place that the bank has to do a certain amount of giving back to their local community. So they'll come up with these kind of niche products that
Yep.
a lot
Yep.
of people don't qualify for,
Right.
and
Right.
that come with a very high interest rate.
Yeah.
That's their way of giving back to the
Yeah.
community.
Yeah.
So
It's
that's
marketing.
typically what you see. Yeah.
It's marketing. It like makes them look good. Oh, we do these kind of loans, but they're kind of hard to get. So and they don't do a
Yeah.
lot of them,
Hard
right?
to get, expensive, high
Yeah.
interest,
Right.
stuff that you don't typically want, stuff that you're usually better off just waiting another 6 months,
Yeah.
get your scores up a little bit, save a little more,
Right.
and get a decent
Yeah.
loan with a good rate. So
Yeah.
yeah,
So when we're
right.
following these guidelines, I mean, I'm going to talk about the types of properties we can do under
Mhm.
these guidelines for Fannie Mae, Freddie Mac, Ginnie Mac, all these people they sell. You can actually, most people know you can do a single family home, right?
Right.
But under
Yeah.
these guidelines, you can do a 1 unit, a 2 unit, a 3 unit, or a four unit. So you can do a duplex, triplex, or a fourplex as well. Um, I had something came up on my screen I had to get rid of. So there are a lot of options. So
Yeah.
single family home for a conventional loan or something that you could sell to Fannie Mae or Freddie Mac, you can do one, two, or three, four units. And a lot of people don't know that.
Right.
And there's some great benefits to buying a duplex or a
Mhm.
triplex versus a single family home. And we're going to talk
Sure.
about that a little bit later too.
Right. Yeah, absolutely. Okay. So along those lines, you've already defined exactly what we cover: single family, 1 to 4 unit. Then we also cover your government regulated versus your government insured or government guaranteed loans. So
Mhm.
government regulated, those are all conventional. Your conventional loans, that's your typical 3% minimum down payment. You're going to have great interest rate as long as you have good credit scores. That's going to be your better way to go. And so for those, they're regulated by the government. So all the Fannie Mae and Freddie Mac guidelines that come out, those are
Mhm.
all underwritten to those guidelines. But then you have your government insured or government guaranteed loans. FHA is government insured. VA is going to be government guaranteed.
Right.
So that they're not insuring it. A lot of people don't realize that, but the VA actually guarantees up to 25% of the loans. Typically, how that works. So
Yeah.
yeah, all of these though, there's all those guidelines are the same across the board, no matter which one of us 330,000 loan officers in this country do your loan. We're all underwriting to the same guidelines. So,
Right.
when it's the third week and we're asking you for more documents from underwriting, we're not just making it up.
Which always
It's
happens, right?
it all pretty much guaranteed every time. Like they know that's a great point too. Everybody's situation is so unique and
Yep.
specific. There's just
Yep.
so many different ingredients into
Right.
this mortgage.
Right.
We're just trying to put this all together and cook this
Yeah.
all up. And there's
Right.
just, everybody's situation is so specific that there's
Right.
always going to be something. Basically, we would have to ask you for 10 times more documentation than we do, just to make sure we don't miss that one little thing that we actually need, and it's not helpful for anybody. So
Yeah.
we just ask for the bare minimum and then let them hit us back with the one or two. And of course, we can anticipate it with experience.
Yeah.
We try to anticipate it the best we
Yeah.
can, but there's always that onesie twosie little gotcha thing,
Right.
and
Well, that's
I
where
got
working
a
with a
whole book
professional,
on.
right? If you're working
Yeah,
with a professional with years of experience and seeing a
yeah,
lot of this, they can
right,
anticipate a lot of this stuff and they can guide you
right,
through it and they can work through any problems that come up, because like you said, everyone is different. Every loan
yeah,
I do the borrower is different, the property is different. So we have,
mhm,
it helps working with someone that knows what they're doing. And a lot
yeah,
of these, call centers that have
right,
fantastic super rates, you're gonna be
mhm,
working with someone who gets minimum wage and just got their license, and
mhm,
unless you have the perfect loan,
mhm.
good luck,
Yeah.
right?
Or they don't even have their license. They're literally just
Wow.
taking the app and handing it to somebody else.
Right.
And they've got three layers of people, and the
Right.
one guy who never even touches your loan
It's a
is the
nightmare.
one. And it's like income, assets, and credit. That's the basis, the meat and potatoes of what's in a mortgage. It seems simple, but there's just so many different ways for it to.
Right.
There's 1,000 ways for the deal to die.
Right.
And it
Right.
just takes a lot of
Yeah.
patience and skill to get it all
Yeah.
the way through the process. So
Yeah. And you
you
talked a little
mentioned
bit
earlier.
about. Go ahead.
So you talked a little bit ago about the benefits of the multiple unit, the 2, 3, and 4 unit properties. What's the main benefit of that? Why don't you help us out with that?
Right. Well, the single family, it's you use your own income to qualify. But with a duplex, triplex, or a fourplex, 2, 3, 4 unit, you have renters in there, so you can actually use that income to help you qualify. If you have a 12-month lease in those, You can use 75% of that rental income to help you qualify for your income and for your debt to income ratio. And the reason they use 75% as opposed to 100% of that lease amount is because they're taking into account vacancy and maintenance and stuff like that. There are some costs to it,
Sure.
but it's very helpful. I mean, it will help you qualify
Yeah.
for a duplex, a triplex, or fourplex. I mean, the loan amount's going to be higher, the sales price is going to be higher, but you have income coming in to help you mitigate that and help with your
Yeah.
income.
Yeah, absolutely. A lot of people don't know that you get to use that income to help qualify.
Right.
It's an awesome way to get into
Yeah.
a bigger place and build equity faster. And in a
Right.
lot of cases, even have, the other three units pay for the whole building where you're
Right.
living almost rent free,
Right.
if you can find it. It's a little tough right now in this market. We all know
Yeah.
that. But the
Yeah.
fourplexes got snatched up a little while ago, and people seem to be holding right now. But hopefully,
Yeah.
hopefully there'll be more of those available in the future. Triplexes, we're still finding quite a few of those available, but if you can find that mythical unicorn fourplex
Yeah.
somewhere, grab it, grab it
Right.
immediately, get it on the books, live there for 6 months as a primary, and then figure out, your dream home after that, once you've got a fourplex paying for itself, so.
Right, right. And
Yeah,
that's a great strategy. I'm glad you brought that up. I mean, a lot of people use that strategy. They'll buy a duplex or a triplex, live in it for 6 months, live in it for a year, and then they'll move out and buy something else. And, so they have a triplex now as a
right.
rental, which is a
Mhm.
great income producing property. And
Yep.
so they buy another one.
Mhm.
They'll buy
Yeah.
another duplex or triplex and live in
Sure.
that for a year or two until they're
Mhm.
ready to buy it. And so they leapfrog, and the trail is having a bunch of investment properties that you can
Mhm.
buy. It's a
Yep.
fantastic strategy.
Yeah, absolutely, and that's a great segue into kind of the last little piece here. Your primary residence versus a second home or an investment
Mm,
property,
yep.
and everything you were just talking about. With the rental income, like all that applies toward a primary residence. So you're
Right.
financing a home as a primary residence or a fourplex if you can find that magic one there. Find a fourplex, buy it, and get it as a primary residence where you're getting a lower interest rate. I
What
don't
does
want to have.
primary
I don't.
residence mean?
So primary, it means it's the home you're living in.
Right.
So it's your primary residence. It's a safer loan. The bank
Hmm.
considers it a safer loan because the bank knows that, if you have a financial hardship, you're going to let an investment property or your second home go before you let the
Hmm.
home you live in. Get the
Right.
roof over your head go. So though that comes with a price though on those second homes and investment properties. Your second home typically going to be about a 0.5% higher than what you're seeing on your primary residence, and then your investment properties are going to be at another 0.5% higher
Right.
again, because that's even more risky than the
Right.
second home.
Right.
So
Yeah.
little piece of tidbit of info to think about on a second home is if you're, because a lot of times we have people that have a primary residence and they want to buy another one and then rent it out later, and so they want to buy it as a second home because they'll get a little bit lower interest. You can do that. You can change your mind, after the fact, but it needs to be a while after the fact. I typically say 6 months minimum,
Hmm.
so, you don't want to buy a primary residence and then buy another one next month because that's mortgage fraud. You'll be investigated, and they do drive-bys. I've had
Right.
clients have inspections done by the lender or by the
Right.
investor.
Right.
There are people, their whole job is to drive by and inspect properties. I mean, I know people that have 10 that have gotten away with it multiple times.
Hmm.
I'm not that guy. And if you tell me you're going to do that, then I'll have to
Right.
send you to somebody else because I won't process the loan. So
Right. Right.
that being said, though, the second home has to be 50 miles away from your primary
Mm.
home. So just keep that in mind as well. So it's
Right.
typically something that where someone's buying a home on the coast or something, or a home on the beach or
Right.
something like that. So it's
Right. Or
typically
next
what.
near the grandkids or something like that, where they're going to spend a lot of
Sure.
time, where
Yeah.
they just need to buy a second home or something like that.
Right.
Yeah,
Yeah.
that's all fantastic information.
Mhm.
Yeah.
Yeah. So yeah, that's all I have. Yeah, just great stuff here. I love the rental income piece.
Yep.
We're looking at leveraging a little bit of that this year ourselves. So hopefully we
Yep.
have some great stories to tell as a result of all that info as well. Yeah.
Great. Well, great. I appreciate your time. I appreciate the information, and I
Yeah.
will be talking to you soon. And if you're
Yeah.
listening on this, to all the viewers on YouTube, go ahead and subscribe to this channel. We're going to be putting out great content like this. We're going to try to do it once or twice a week. If you're watching this on Facebook, go ahead and like the page. and so that you get a notification of when we put out a new video. On YouTube, if you want to click that little bell, you'll get a notification of when a new video comes out.
Great, yeah, and even some of our competitors, other loan officers, feel free to copy our content. You know, by all means, take it, use it, put it out to your clients. Let's all get better together.
Yeah.
Comment in our stuff. If you have anything to add to anything we've said here, feel free. Please put it in the comments. We'd love to grow and learn together and just get the word out to everybody. Thanks so much.
Yep. Thanks, Sean. Have a good one. I'll talk to you soon.
Okay, Jess. See you.
Bye.
Bye.